understand. And so oftentimes we see people fighting to keep the house, but there's some pitfalls, right? There's some things that we
Absolutely.
don't think about. So let's have a conversation a little bit about what that looks like. Let's look at the big picture, right? So what's the most common mistake you see homeowners make with property taxes after divorce or even after the
Uh,
sale period?
yeah, so I think the number one thing that I see typically pertains to first-time homeowners who have purchased their dream house. They bought into a brand new build. They've gotten that custom house. It's exactly as they want, and they've assessed their budget at the home price, thinking that that home price is it. And what I mean by that is oftentimes when people are buying a home, they're assessing their affordability based on what the monthly payment is going to be without taking into consideration, throughout just not having the knowledge of the fact that when they buy that house brand new, that tax bill that they get is incomplete, meaning that initially that tax bill that they see, because most people pay their property taxes through escrow, through their mortgage company, is only assessed on the land value, not the improvement value. And the way that catches people up is oftentimes there is a what's called a reassessment, where the value increases based on the value of the house now, not based on the value of the land when they bought it.
Awesome. We're going to put a pin in that because we're going to come back to that just a little bit later. Um, so a property is assessed, right? It's an estimate. If the house is
Mhm.
brand new, if the house is standing, it's based on the most recent assessment. And how does that work? How do assessments work?
Yeah, a couple of different ways. So, oftentimes it is based on neighborhood sales comparables. Oftentimes it is based on a drive-through of the county tax assessor actually coming out and assessing the property and giving it a value based on comparable values that they see in neighboring properties. But they also take into consideration the specifics of that particular property. So, if, for example, there is a comparable home not too far, but the improvements to your house, the condition, there are things that they call what they call. Oh man, the word escapes me right as I'm trying to think of it. Basically, the use of the property. If there is additional improvements, if there's additional structures, if you have done things to your house to make your house just a little bit nicer than the neighbors, those things are going to come into consideration. How your land is divided, the way that is zoned, the proximity to other things, all of those things come into account to determine what the value of the home is going to be. But also, if you have any special land use types, there are special tax there are tax categories that your property can fit into based on if you're trying to use your particular house in a particular way, especially if you have large amounts of land that you're using, you can get special exemption statuses and things of that nature that only apply to you and only apply to your ownership of the house.
Mm. So when a couple divorces, how can title transfer, a quick claim deed, or refinance impact property taxes?
So there are a number of variables that go into a property tax assessment. There are things such as people don't oftentimes recognize this, but let's just say, for example, if you are married to a veteran, the veteran status may have that home assessed at a lower tax value that applies to that veteran that may no longer apply to you after the divorce if you end up keeping the house. So whereas the veteran may have been assessed at a lower value based on the veteran status, that may no longer apply to you. We may also be dealing with whether or not the homestead exemption is still able to be applied to you as a new owner. You cannot have a homestead exemption, for example, in two different locations. And in order to have a home,
Go ahead, keep going.
okay, in order to have a homestead exemption continue to remain on the property, if the ownership changes, for example, the two of you split up, whomever had the initial homestead exemption is going to have to file a removal of that in order for the new owner to be able to take possession of that homestead exemption. And it's oftentimes a step that people forget to do.
So let's pause for a second. What exactly is a homestead exemption and how does it benefit a homeowner?
A homestead exemption is a tax status that indicates that you, as the owner, are intending to live in that property and you get a tax break on your property taxes to assess it, your actual tax bill a little bit lower because you are an owner occupying resident of that property.
So it's a little bit different. So if you have an investment property, your taxes will be a little bit more. So it really depends on what the property is being used for. And if, with the homestead exemption, you're saying to your local municipality, this is my primary residence. I'm using this property specifically for my home. Is that correct?
Correct. That is correct.
Awesome. So why do so many people underestimate how much property taxes can increase?
Because it's a very opaque process. There are conversations around property taxes that are not really fully understood, such as your property tax is actually divided amongst a couple of different municipalities, and they can do what's called a millage rate at different rates depending on what they're trying to do. So, for example, in our particular location, we have the city that does their tax, the county who does their tax, and the school board who does their tax, and they're all milled at different rates. And each municipality is able to set their own millage rate. So, if, for example, the city decides to increase their millage rate, the county does not, and the school board does, you may be facing an increased tax bill without you understanding exactly how much that's going to be going off of. And that's the thing that oftentimes gets people caught up. Um, I would also say that we also underestimate how rising property values really affect existing owners. There's a common misnomer that I hear from homeowners or from people in the real estate industry all the time is that your mortgage payment doesn't change. The only thing that doesn't change is your principal and interest portion of your mortgage payment. Your taxes and insurance are absolutely going to go up based on your new value. So if you're in an area where the property values are continuing to rise, even if the millage rate doesn't change and you get a new assessment and the value of your property increases, you're going to have to insure it for more. The mills are, even if the mills apply the same, it's applying to a larger value of the property that the city or the county assesses it at, and your bill is going to go up. Those are things that catch people off guard. Yeah, I'm sure anybody who has been in their home for more than 3 years or so has gotten an escrow shortage notice from their mortgage company at some point.
So let's talk about what an escrow shortage notice is. And that's a very interesting point. So tell us about that.
Yeah. So again, I mentioned earlier the property in interest, the principal and interest portion of your property of your mortgage payment is specifically tied to the loan. So whatever amount that you got a loan for, and the interest rate that you got your loan for determines the principal and interest portion of your mortgage payment. Your taxes and insurance portion, however, are not based on that loan. Your principal and your taxes and insurance portion are largely based on the property value. So your escrow is an account that the mortgage company holds that portion of your payment in until those bills come due. They're due once a year. So your mortgage company is taking a little piece of that PI and TI portion of your mortgage payment and is putting it in an account, setting it aside so that when those bills come due, your insurance bill and your tax bill, the money is available for them to pay it on your behalf. You can obviously choose not to do that if you want to pay it directly. You can pay your property taxes and your insurance directly if you choose to. Most people don't. Most people include it as a part of their mortgage payment because it's a simpler thing to do. But if the mortgage payment, or excuse me, the tax payment and the insurance payment come in higher than what was estimated, and they took that portion out of your mortgage payment and you're short, you are still responsible for the difference. So for example, I remember when I first got into this space, and I got a reassessment. I got a reassessment for 3 years straight. First was 800, then was 1200, then was 1700, and they're supposed to do a reassessment of your escrow every time that you have a shortfall. Sometimes they don't do it correctly if the values are increasing more than they anticipate. But what ends up happening is they'll send you a notice. You are short. Your escrow is short this amount of money. You've got to pay this extra by this date, or your mortgage payment is going to go up by this amount for you to make up the shortfall for the remainder of that term and hopefully have enough to be able to pay it the next time it comes around. They are not going to take that hit to the chin. That is your responsibility as an owner. You've got to be prepared for that because it can happen whether you anticipate it or not.
Okay, so let's break this down. let's say for the sake of conversation, you have a $300 or $300,000 home. Your principal and interest payment, if you have a 30-year loan, is going to remain the same. The principal and interest will remain the same throughout. However, if the county comes over and they now say, based on the home sales in your area, we see that your house is worth now $400,000. Okay. So initially you're paying taxes and insurance on a property that's 300,000. Obviously, at the end of the year, your mortgage company has saved that much to pay your taxes on your behalf. However, when that tax bill increases, you don't have enough in that savings account from the mortgage company to pay those increases in taxes. So not only do you have to pay for the shortfall, but you also have to have enough money in that account for the increased value as well. Is that correct?
That is correct. And that's going into the next year. So you can anticipate having to make a lump sum in addition to an extra padding on that payment to make sure that that money is there next year, assuming that there's not a significant increase again the following year.
And that could be two, three, $400, depending on the reassessment. And not only that, but you're not anticipating that. When you're looking at numbers, when you're going into court, you're looking at them based on last year's information. But there are things that can trigger that reassessment, and we'll get into what those things are. Aside from property values, there are other things that can trigger that reassessment. So we talked a little bit about the veteran exemption, but what other exemptions can be lost during a divorce, and how does that show up?
Yeah, well, there are a few other things that can go into your property tax bill, such as again your are you in the city or are you in the county? Those things are going to affect your tax rate. Are you, for example, are you over the age of 62 where you get an exemption for not having to pay taxes in that particular school district? Does the area that you're having to move to, is it going to continue to have that? Are the exemptions that you have tied directly to your ex-spouse's particular special government status? All of these things are gonna play a role. And when those things get removed, let's take for example, there's a common thing that we did within the Board of Tax Assessors, which are what they call conservation use statuses. That can be, for example, if you're a person who has a large plot of land, maybe it's been passed down through generations in the family. The county will give you a special tax status as long as the property is used for this particular thing. So it can be, for example, you're just growing trees on it and you're going to use that for timber, or you're going to have you want to keep it as a nature preserve so that the deer and the squirrels and so on and so forth can roam freely on there. You can have that as wildlife. If you're going to have horses and cattle and things like that, you can have it as agricultural. But then based on the divorce, you for whatever reason need to change ownership. Perhaps that person doesn't qualify now, or you decide that you want to sell off a portion of the land to make up some of the costs. That can trigger what's called a breach, which ends up charging you penalties to the city or the county based on the fact that the plot of land that you use for this particular conservation use is no longer applicable because you have altered it in some way, shape, or form. And oftentimes, the thing that we see at the Board of Assessors level is breaches from somebody passed, somebody got divorced, they decided to sell off a portion of it, and now the entire thing is breached, and they don't know what to do.
Wow. Okay. So we talked about the assessment. So how do property tax delinquencies complicate like settlements? So what happens at the Board of Tax Assessors when people are delinquent on their taxes?
Yeah, so at the Board of Assessor level, we don't deal with the delinquency portion of it. But what does happen is people oftentimes forget that the taxes are always going to be a first position lien on any outstanding amounts due on a property. So obvious, I won't say obviously. It is pretty common knowledge that the mortgage holds a very high position. So if a person is delinquent on their mortgage, the mortgage holder can foreclose on the property and take possession of the property back. Understood. But oftentimes we forget that the taxes supersede even the mortgage on the property. So if for whatever reason a person decided that they wanted to pay their taxes directly and not do it through escrow, as we were just describing, if they don't pay that tax bill, that tax levying authority has the authority to foreclose on that property for whatever amount is owed on it. Meaning that we've seen properties foreclosed for as little as $3,000 owed to the city or to the county on a $400,000 home. Somebody is getting an incredible deal. Somebody else is losing a significant amount of equity in their property because they forgot to make that payment. They will notify you. You will get a warning. But again, oftentimes when we're talking about two people splitting, who does that go to? Did it get lost in translation? Did it get properly delivered to the appropriate person? And when those things get missed, you have a lot of money that gets left on the table, and a lot of pain and heartache as a result of that.
So I want to recap something you just said that's very, very important. Tax delinquencies trump mortgage delinquencies. And that is the reason why the mortgage company decides to collect taxes on behalf of the homeowner. So the mortgage company knows that those taxes are going to get paid, because if the tax assessor, not the tax assessor, but the tax jurisdiction forecloses on that property and there's still a mortgage owed on it, the mortgage gets wiped out. So the mortgage company is not necessarily doing you a favor, although they are, so you don't have to think about it. But bigger than that, it's a business and they understand that the taxes, if delinquent, can completely wipe them out. So that's a big deal. Um,
Absolutely.
and that is the reason why the next thing is how property taxes can turn what looks like an asset into a liability. Because at a certain point, you think your mortgage payment going into a divorce settlement, you're looking at straight numbers from old data, right? And
Hmm.
what we're saying in this case, divorce makes new data. And that new data can contribute to an increase in assessment, payment, taxes. So maybe your mortgage payment was um 2,000 and your taxes were 500. This reassessment could make your payment go up to, another 500 or $600, and you're not aware of that because you're making up for a shortfall as well as preparing for what's going to happen moving forward. So for many people, they think keeping the house is the best thing. They don't realize that they may become house rich and cash poor because of things that are not even generally brought up in court, because the court doesn't handle that. So if you don't know that these are the things that I need to be aware of going into it, you may be setting yourself up to go into a trap where you believe that you are getting a house that might be affordable, and just like that, it no longer is.
Absolutely. And there are other variables and things like that too. There are, for example, for a property where an owner has challenged the value of a property, right? And we see this oftentimes with the Board of Assessors. Hey, my property is taxed too high. Uh, well, if a property goes through that hearing process and it is ruled in their favor that the property is indeed adjusted, that property is not reassessed for 3 years, provided the owner maintains ownership of that property for those 3 years. So
Mm.
we have to keep that in consideration as well. If the property is, for example, in that locked out status, and then the ownership changes due to a divorce, that reassessment is going to come early because now ownership has changed. That part is very important for us to remember. Anytime that there is an ownership change and there is supposed to be a change of the listed recorded owner on the tax with the tax levying authority, there is an opportunity for a reassessment at that point. Now, it is important to know that at least in the state of Georgia, that is typically done by the 1st of January. But what that also can lead to is if something happens, for example, on January 2nd, you may not be seeing the results of that until a year and some change later once they do the reassessment the following year. So there can be a delayed trigger on that.
So that's the surprise, right? So you
Right.
think that, okay, so I got divorced on January 15th. Those taxes are due. Are those the ones that are due later in the year? But the reassessment doesn't come until the following year. So I have no idea that I'm getting ready to get hit with this big burden until it's way too late. Is that correct?
Absolutely. That is absolutely correct. Absolutely.
Ah. Okay, so we talked a little bit about, what homeowners should be aware of, but a bigger question is how can, someone who is fighting for the house, how can they project the future property taxes to make a smart decision about keeping or selling the home?
Yeah, that's a great question. The good news is that you can see previous tax assessments on the county site as public information. The thing that I strongly recommend any owner do who's fighting for the house is take a look at previous tax assessments to see how things have been trending. Also, millage rates for those tax levying authorities are also public information. So, as again, I mentioned the school board, the city, and or the county, you can contact those tax levying authorities to get an idea of what the tax millage rate is for that particular year. And then it's just a math equation, right? Based on the assessment of my property over these years and based on the millage rate that's for this year, this is what I can expect to pay. But I strongly encourage that as you're going through the process, reach out to both the tax assessor's office and the uh, the tax levying authority and have these conversations. They are your public service and they are there for you to be able to ask questions. They are there to give you the information that you need to be an informed homeowner. What tends to get a lot of people is the fact that they don't recognize that these entities are there specifically for them to provide this information and they don't know what questions to ask. So as we're fighting over the house, right? We need to understand, what is the property even assessed at? Are there any outstanding taxes? If so, what is the amount of outstanding taxes and how much time do we have before the county, city, or levying authority takes action on it? If there are not, are there any proposed millage rate increases that we should expect? And what is that millage rate going to be? Because they have a deadline to be able to give you that as well. This year, for example, it changed and it was September when historically it had been in July. But the point being, ask the questions. Go to your tax levying authorities, both the assessor and the tax commissioner, and ask these questions so that don't ever be afraid of sounding like the ignorant one, because you're the one that's asking questions that you need to know. They have to tell you this, and they have to make sure that this information is available for you as an owner.
And I'll be transparent about myself with one of the properties that I had, that there was an outstanding tax lien on the property that had actually been sold to another party. Fortunately, I had kind of an alert on the property and realized that happened, and I was able to take that into court. And we were able to take that into consideration, but we don't always know. And so, if you don't know how to protect yourself in that situation, something like that can happen without your knowledge. Very
Absolutely. And another point on that, though, which is also really important to know what your reclamation period is for your particular area.
so pause.
Reclamation period.
Thank you. Go ahead with reclamation.
I was going to say reclamation period is a period of time that you, as the owner who has the tax lien or tax foreclosure, has to be able to make it whole and reclaim your property. So just because your property is up for tax sale or sells in a tax sale doesn't mean that you don't have any rights. You have an amount of time that you have to be able to take action and to make that tax lien whole to be able to get the title of your property back. But you have to know what that is so that you don't miss your window.
And you need to have the money to do it.
That too.
That's awesome. So, are there any tax relief programs or abatements divorcing individuals should know about? I think you just
Mm.
mentioned it with the reclamation period. What else? Anything else?
Yeah. There are there are questions that you have the ability, you have the right to be able to challenge a tax assessment uh, within 45 days of a tax assessment coming out. Now, there are if the tax assessment period has already passed and we're in that process, then that window has probably already changed and there's not really much you can do. However, if we know that the following year you're going to receive another tax assessment because you're going to receive one of those every year, if there is a challenge that you would like to propose at that point in time, when you get that tax assessment, you have 45 days to be able to challenge that. When you challenge it successfully, they automatically have to reduce the amount that you're being charged for that tax year to 85% versus 100%. So, for example, whatever amount that the tax bill or the tax assessment that you've received, they're going to take 15% off of that while you're in the challenge period, which gives you a little bit of time for you to be able to work some things out. And then you have some options as far as how you want to present your case to the tax levying authority. For example, this happens very often where perhaps the tax assessment is based on outdated data. So they're assessing your property at a higher value, but the market has corrected. And the value of your property has actually come down some. But the tax levying authority doesn't have this information yet, but you can get it from your real estate professional. Maybe the house that's next door to you or up the street from you or a block away from you has actually sold for $50,000 less than what it was originally assessed at. That's information you can use in your favor to go back to the tax levying authority and say, hey, property values are actually coming down, not going up. It's oftentimes also worth it completely to pay for an appraisal of your own, so that you'll have that information on what the tax is valued as well. Any information that you can get to support your case, because when we're talking about taxes, you want your property. I know when we're talking about net worth and all those things, we want our property to be valued as high as possible. But when we're talking about taxes, we want the property to be assessed as low as we possibly can. So anything that we can use in our favor, anything that we can use to bring the assessed value of that property down just a little bit. Hey, it's close to a railroad. Hey, across the street or up the block from me, they're doing construction and they've rezoned this as commercial, which is going to reduce the appeal of this particular property. Perhaps there is some form of defect that has been discovered on the property that the tax assessor may not necessarily be aware of. You can challenge all of these things to try to bring your assessed value down.
Awesome. So, transparent moment here. You were front and center in the center of my divorce, and taxes were not in anywhere in the forefront of my mind at that point, right? So I was trying to get through the process, as many people do, especially in high conflict situations. This is the reason why it's important to have a team that really can help you through that process. And a real estate strategist is central to that. But bigger than that, what advice would you give to attorneys, mediators, and other real estate professionals to help their clients avoid these tax pitfalls?
Great question. The thing that I see that I think probably frustrates me as a real estate professional more than anything is the fact that these are professionals that are here to guide their clients and they don't even know to ask the question. They don't bring in another professional that may have awareness where they're blind to use them as a consultant to help make sure that their clients are being served to the best of their ability. If you are an attorney, for example, and real estate is not your forte, it's perfectly okay. And it's in your client's best interest to say that and recommend that they have another professional that they hire, not just a real estate agent, because let's be perfectly honest, there's a wide range when it comes to capabilities of real estate agents. You want to find somebody who is an expert in the real estate space. An expert, I define that as a person with knowledge, experience, expertise, and training in that particular space. Not just a license. A license is very easy to get, but the knowledge, expertise, experience, and training is difficult to come by because the barrier to entry is so much higher. You want somebody who has through some things and has the record to show that they know what they're talking about. But most importantly, as a professional, I strongly encourage you partner with other professionals to make sure that your client is served to the best of their ability. What the thing that I see oftentimes, particularly when it comes to divorce, and you can attest to this, is that you as the person going through it don't know what you don't know. And you are trusting that the person that you've hired as a professional is giving you the best piece of information. And they can't do that if they don't know that particular area, right? So if they were able to partner, hire a consultant, find somebody who has a proven track record in that space that they can, if nothing else, refer their client to ask questions, it'll put their client in a much better position to avoid as many of these blind spots as they can. Real estate is it's a very dynamic space. There's so many variables that go into it. And I don't think it's not a reasonable expectation that an attorney who practices law is going to know all of the variables in real estate transactions. And that's fine. But we have to be sure as professionals that we are not we are not so arrogant that we don't recognize our own blind spots to be able to give our clients the coaching and the direction that they need to find somebody who can answer the questions we can't answer.
Exactly. In all fairness to real estate agents too, real estate agents are not tax professionals. They're not financial planners. They're not appraisals. The real estate agent's job is to guide you through the buying and selling contractual process, right? How these things impact you long term, what these mean for your taxes, what these things mean for you over the long term financially. Real estate, that's really beyond their scope of understanding. And so while they can guide you and help you through the transaction and say perhaps you need to contact these other professionals, to expect that one person knows all of these things, especially when you're in a high conflict, high net worth divorce where real estate is centered to that, right? You need to make sure that you have a team that is in place and the team really is working together. The challenge comes in when your professional doesn't even know who to ask, what to ask, or they just really want to move through the process quickly, leaving you on the hook for things that could have been addressed, but they weren't. So, thank you so much for that. We talked about the pitfalls, right? You gave the piece of advice, which is make sure that whomever you're working with has someone in the space that can help them with their blind spots. The attorney is not a real estate professional. Your financial advisor is not a real estate professional. Your mediator is not a real estate professional. All of these people have their area of expertise. However, they're not able to talk to you about these things in advance to have you plan for what this might look like financially if they don't know. So thank you for that. So, Jarrett, thank you so much for giving us this expertise. Talk to us about these pitfalls. But here's the thing, right? We're here at the Abode Global Living Group. I am here specifically to make sure that women understand in going through a divorce what these hidden wealth traps are so that you can prevent these things from happening so you're not blindsided by them on the back end. So if you're in the middle of a divorce, a high conflict divorce, and you have questions, reach out. While I may not, Jarrett may not, other people may not be able to answer all of your questions, perhaps we can help point you in the right direction. Do you have any final words?
Yeah, I think that the most important thing that anybody can do is ask their questions, use their resources, and don't be afraid of asking the quote unquote dumb question. Most of these things that people find themselves encountering are things that they didn't know that they didn't know. And while that's perfectly fine, that's to be expected. The goal of you having professionals is to guide you through those things that you don't know. So do not be afraid to ask for help. These divorces are one of the most tumultuous, most draining, most dynamic and conflict-ridden experiences that most people will go through. And while you're in the midst of that, trying to keep yourself together, you want people in your corner that you can trust that will guide you and lead you in the right direction.
That's awesome. Thank you very much. This is Tisha Mitchell from the Abode Global Living Group. Jarrett Mitchell from the Board of Tax Assessors. Thank you so much for your expertise and spending time with us today.
Thank you for having me.
That's it. You did it.
All
Oh,
right.
I don't want to push in, but I do want to stop the recording. Okay.